Welcome to this webinar, folks. Today, we are going to talk about a little different angle. What you need to have as a trader to get your profitable trading. So far, we talked about a lot of technical trading strategies. Why did we talk about these strategies? We talked about all this Ichimoku, then the flat lines, Fibonacci, Haikanashi, and all those things. But how does it make sense, right? How do we use it? That is the whole point behind it, right? So very soon in the next webinar, also I want to talk about trading plan. What do you need to have in your trading plan? It should be a written contract that is with you itself, telling that this is what I would do. But before going into the trading plan, you need to have this basics of the trade setups. How do people set up their trade? You need to understand what the market is doing and all those things. That's why we picked up this topic. So let's go. So it's all about reading the price actions, okay? So first of all, before I get into the details of it, let's give the disclaimer. All the information in this trading webinar is for educational or information purposes only. The viewers of this or the members of this webinar can use this information for their investment decisions. However, techie investor would not be responsible for those investment decisions. Trading decisions involve substantial monetary risk, and you should use all your information available, and you're solely responsible for your investment decision. That's what this disclaimer is all about. Okay. So after having gone through the disclaimer, let's get to the chart. So we are going to talk. Oh, sorry, the topic. Okay, the agenda for today is first of all we are going to talk about market dynamics, and then we are going to talk about what is the price action and how do you compare it with the indicators. And then we'll talk a little bit about how the market is structured. How does it work? Then we'll talk about the support and the resistances, and followed by the framework. What should your framework have? For any person who is looking to trade should have a framework. Like when I say framework, it means like what are the setups that they look for? And if they look for a setup, how do they get into the trade? How do they execute the trade? And how do they exit out of the trade? This all things should be in the part of the framework. And finally, but not the least, is the risk to reward ratio. How do you take care of it? And we'll also talk about some examples, okay, after that. So why is this like this? Something is like, okay. The market dynamics, right? The market dynamics, what happened is, a lot of people think that, why do you think the market goes up or down, guys? Any idea? Anybody can answer that question? Hello? Okay.
Could be many things, right? I mean, it could be some news coming up or earnings coming up, right? Or
okay. Okay. So you're talking about an event, right?
Yeah,
okay.
An event, yeah.
Okay. Anybody else?
When people are buying and selling the stocks.
Good. Very good. Okay. What do you mean by buying and selling a stock? Is it like more number of buyers or more number of?
Yeah, if when more number of people are buying, the stock will go up. More number of people are selling, the stock will go down.
Okay, that makes sense. Okay, that's good. That's on the point. Yes, you're right. But let me. Yes, what you said is absolutely right. When there is a lot of, I'll frame it in a little different words. We'll call it as a buying pressure and selling pressure. Okay. When does a buying pressure happens? When there is a lot of buying involved than selling, right? So when will that happen? For example, right, it need not be the case where there are a lot of buyers. There can be a lot of buying pressure. For example, let's say there are 10 retail traders who are trading on Netflix and they are buying 10 stocks or 20 stocks or something like that, right? And there is one institutional investor who comes and says, sells Netflix for $1 million. So automatically there's a selling pressure created, right? Though there are lot more buyers, right? So it matters with the volume of the stock, right? Volume is happening. So that is what is important. That is what we went by. That is how market dynamics work. So it doesn't matter with the event. It doesn't matter with the fundamental news or whatever. It matters with the buying pressure and selling pressure. That's all it matters. Who is buying, who is selling. That's what it is. That is why you see even during news, even though they have given an excellent quarterly results, the stock may fall down because there's a lot of selling pressure. Okay, so or there could be some cases where the market reports were really bad, but it went up. For example, look at Boeing recently. Boeing just went up for the news that the COVID things have come up, for the news that their restrictions have gone down. But look at, but they haven't given any quarterly good results, right? So it is so there was a lot of buying pressure at a particular point, and that rose the thing. So you got to understand that that is what drives the market. It is not any fundamental news. It is not any event or anything like that. Okay. Now, the second stage, what we are talking about is the price action. So when I say buying pressure or the selling pressure, that means it's the price action. What does this price act? So when you look at a chart, if the chart is telling you, hey, there's a lot of buying pressure, that means you want to be with that market. You don't want to be saying, hey, I want to go against and sell it against it, right? That's going against the trend. So price action means you're looking more at the price itself. And that gives you an objective view of the market. For example, the SPY recently has been going crazily onto 364 high, which we'll look at later. But what I wanted to sell is, though it came back and it didn't touch any of the support or resistances, it went up. And it is still going up because there's a lot of buying pressure there. People have been buying stocks since the COVID news, since Pfizer and Moderna came up with the news that their vaccines are 95% effective. So the news is important, but how the market reacts to the news is very, very critical. Okay, that's what I meant to say. So what is the advantage of using the price action itself? First of all, you can ignore the fundamental news. For example, you don't even have to look at the fundamentals. A lot of times I ask people, hey, what happened in the news? The price is going up. Because I can see the price action immediately, because that is the first thing that will change. Have you seen this, guys? Have you seen these news, guys? If the price goes down, they'll come up with a negative news. And if the price goes up, they'll come up with the positive news. That means they have lined up both the news according to the situation. They don't control the price action, but they have the news according to the price action. Okay. So you got to understand that I'm not against the fundamentals, guys, but when you're looking at the price, that gives you a more accurate view of the market. Okay. Then if you know the price action, you can definitely better time your entries and exits, right? Because you know that the price is going up and you know that, hey, I can definitely enter the price rather than relying on some indicators or some fundamental news. Like, for example, if you take, recently we played Urban, and Urban had, I don't know how earnings came up today. We'll look at it later. They had earnings today, but we played it on Friday and we got a 60% returns on it. Even though the event was today, we could have missed that price action, right? For the 60% returns. We don't know I don't know what happened after the earnings, but definitely I'm happy with that returns. Okay, that's what I meant to say. Then you can also develop a framework around to trade in different market conditions. Remember, we were talking about combination of multiple strategies that we were talking for all these things. So you can develop a framework around it, and you can automate your trades, or you can you can trade more consistently for consistent returns. So that is the biggest advantage if you follow the price action. But if you follow the news or if you follow any other indicators, it is not the case, right? That's what it is. So what is the disadvantage of using the price action? The disadvantage is there is a lot of subjectivity involved. What do I mean by that? There are different traders with different experiences who are trading this. So they might look at a particular price action and they might interpret it in a different way, right? So this is what happens. For example, if you are saying, hey, I am only looking at the price action, but you are not looking at the support and the resistances, and you say, hey, it went up, but you're not looking at the resistance there, then it might be not a good idea to trade at that point of time, right? That is why you can eliminate this subjectivity if you have a framework. That means it captures all the necessary elements for you to trade. Okay, that's what it is all about. Then second thing about this is the framework that we are talking about, it takes a long time to validate, guys. For example, the framework that I have been using, I've been using it for more than 10 to 12 years. The reason for it takes longer because you have to test all kinds of conditions. And in trading, there is nothing like 100% probability. There is always a case of like, there is always a cases of like it not being captured in a different market condition. So you're looking for a framework which works about 70 to 80% of the time. You don't want a framework that works for 100% of the time. It's impossible actually to create one like that. Okay. So those are the disadvantages. So you should develop, it is very tough to validate a strategy, even to back test or front test. It takes a lot of time. Okay. Now, so far I talked in comparison with the fundamental news or anything like that. Now let's talk about indicators. There are different kind of indicators. Like for example, Ichimoku is also an indicator. Then also you're talking about RSIs. You're talking about moving averages, everything, right? Now, you got to understand indicators are good. I'm not saying indicators are bad things to use, but you need to understand how they are determined, okay? For example, if you take an RSI and you say, hey, you're by default, most of the charting platform gives you the 14-day RSI. What is the RSI compute? RSI computes, it computes the difference between the maximum, the gains and the losses in a particular time frame, right? Now, that means it says relative strength index, right? Now, if you do it for a 14-day period, and later if you change the settings to a 10-day period, the results will be different. Now, how would you determine your overbought and oversold conditions? So that comes from your framework. If your framework is using an RSI 14 and it has been very well tested, then yes. But if you change that parameter to 10, then it becomes a big problem, okay? So you got to understand how to use the indicator. Similarly on time frames, right? Are you using daily time frames for your framework, or are you using a multiple time frames? If you are using multiple time frames, has it been back tested? Has it been done that? So you have to be very, very careful about using the time frames also. Okay. So for any questions, guys, before I proceed? Does that make sense?
Yes.
Okay, cool. I just wanted to touch this. So let's move on to the next slide. So as I mentioned, indicators are useful as long as we understand how it works. So that's one thing. Now, next we are going to talk about the market structure. How does the market work, right? The market consists of 4 stages, guys. The number 1 stage is called as the accumulation stage. What happens is, after a decline, let's say if the market is in a downtrend, right? Or let's say a particular stock or SPY is in a downtrend. What happens is after it is in a downtrend, it's not going to go straight up like a V curve, right? It is going to accumulate. That means it will be like a range market in a downtrend. So that is when your moving averages are all getting flattened out. For example, in this example, we are showing the 200-day moving average. It kind of gets flattened out. And why does it get flattened out? Let me tell you with the next stage, which is called as advancing stage. So now if I talked about before, you can use the 200-day moving average as your support or the resistance, right? Suppose. I'm just giving an example here, but you can do anything. It could be a flatline support, or it could be a 20-day moving average. It depends on where your charts are. So if it breaks through that, that means what? That means from the downtrend, the stock has become an uptrend, right? And that's when the prices form higher highs and lower and higher lows and higher highs. That means the stock keeps advancing. If you see according to this chart, right? It keeps advancing, and then you see that. So after type, right? Now, as you understand, stock market always is equal, right? That means it is up 51.7% of the time, and it is down 46.6. 46.6%, like that is the statistic, that is the proven statistic. So it's not going to keep going up all the time. Now, the next stage is called the distribution stage. It is like a range market in an uptrend. At this point of time, that is where our market is right now, the SPY. The SPY is like kind of in a distribution stage. It is not forming a higher high. It is not forming a lower low. It is somewhere in between, right? If you had noticed the past few days, at least the last week, it had formed a low of 350.51. I will talk about it later, but I'm just saying. So this is one thing you want to look at. So the distribution stage is like a range market in an uptrend. So what happens? The smart monies will get out of this position, anticipating a lower prices. Okay, this is called as a distribution stage. And finally, what happens is called as the declining stage. At this point of time, what happens is your market will break through the support and it will decline. Again, it's called as a downtrend. Okay, so why you need to know these market structures, right? That's a very good question. See, this will allow you to be a buyer or a seller of the market. So when you look at the charts, you need to understand what stage is in the market, what stage is the market in. If you think it's in an accumulation stage, then you would wait for it to break through. If you are a buyer, you will wait for it to break through the flatline support, let's say, and then you will place your orders. If it's an advancing stage, what you would do is you will be in the market, but you will keep moving your market with the higher trailing stop losses or anything like that. If you are in the distribution stage, you would either be sitting on hands, not doing anything, or you would say, hey, it's a range market. I know this is the range that it is going to be in, so I will play according to the range. So it might be like you could play spread strategy. Like the spread, this is from this range to this range, so you will only play those kind of strategies. So, and if it's declining, you will go directly saying, hey, I will sell the stocks, right? Those kind of things. So it's very, very important, guys, to know in what stage the market is in. Okay. Now, remember in the accumulation stage, I told you it breaks out of the support and the resistance. We already talked about this in a lot of our webinars, right? The support and the resistance. Once the support, once a stock goes through a resistance, it becomes a support. That the resistance that is broken becomes the support. So you got to know these levels. Why? Because let's say you have a flat line. We'll do this more with an examples later, but just wanted to bring this up. Let's say your market is in accumulation stage. And the moment you break through the 200, let's say I give you 200-day moving average, what happens? The buying pressure increases. The buying pressure gets more than the selling pressure. There is at any stage of the market, right? When it is in a range, it is debating whether the buying pressure should be more than the selling pressure. But when it breaks through the resistance, what happens is that becomes the support and the buying pressure increases and the prices increase. Similarly, in the declining market, when it goes below the support, the support, what happens is it becomes the resistance and then the selling pressure increases. So you got to understand that the selling pressure and the buying pressure are very high at the support and the resistances. So you got to be very aware of this, and you should use the strategies that are used by most of the traders. The reason being is, if you use a strategy that is not used by most of the traders, then you might not see the buying pressure and selling pressures at that point. So what I showed you right now are some of the popular strategies that are used by the traders, flat lines, moving averages, and the trend lines. Okay. Now, next I wanted to talk a little bit about the framework. Now, as far as the framework is concerned, you want to be in alignment with the market. So you want to have a couple of things available for you. First of all, what are the stocks that I should enter? That is your scan list. How do you enter that? For that, as we had been preaching for the past few weeks, we can use Ichimoku, because Ichimoku tells you if it is above the cloud, then you can go for that's a good probability of that stock to go over to give you better, to give you good profits. If it is below the cloud, then you can short the stock and those kind of things. So entry points, as I remember, these are the points where the buying pressures and the selling pressure increases. Why would you want to buy somewhere where there is not enough buying pressure? So you can write there buy at the crossovers. What I meant by crossovers, for example, the flat line. Let's say you have a flat line support. As soon as it crosses, you can buy it. There's a big advantage to it too. The reason being is you can also make your risk to reward very high. The reason is if you are buying at the flat line and if it goes up, your reward is very high. And you can sell it the moment it crosses back below the flat line. This is very, very, very important, guys, because if you don't do that, then what happens is your risk to reward ratio is not very high, and it will ultimately affect your trading strategy, trading profits. Okay. Then if you come to the time component for the options, this is only for options, not for stocks. We have also discussed a few strategies like the Fibonacci time zones, which will tell you where the stock, what are the different time zones where you should be considering the stock. Okay, we'll look at it a little bit. Then we also talked about last week the Gann fans. The Gann fans will tell you, hey, for the price that I'm expecting, will it reach that price in my expected time frame? So you can accordingly choose your options expiration. Then the trend lines also gives you a kind of hint, hey, is it possible to get to that? Okay. But most predominantly we'll use Fibonacci time zones and Gann fans. Then the exit points. Exit points is again, there are two kinds. One is the stop loss. As I was mentioning, it's a breakdown of the crossover. Whatever you're using, use the breakdown. Now this breakdown, for example, if you're using 2-day above the Ichimoku conversion, the moment you cross it over, we can go and say, hey, if it crosses below the baseline, which is very close, then we can say it's closer. It depends upon that, your time expiration and what is your risk tolerance. Okay. You want to definitely make sure that your stock is meeting the requirements on which you entered the trade. Okay, that's what it means. Then the target points. The target points is when the stock is going in the direction you are expecting, and you can calculate those things using your Fibonacci extensions and retracements. Okay, that's another thing which you can do. And also you can use trend lines to a certain extent here. Okay, so this is what the framework will help you guys. We'll be talking more in detail when we do our next webinar on the trading plan. How can we do this? We'll touch this much more in detail, but you need to have these things in place for your trade if you want to be a consistent trader. So good risk to reward ratio. As I mentioned, entry point close to support and resistance. If you're buying, then I would highly recommend you to be close to the support because that's where the buying pressure increases, and you would get a good risk and you will get a quick reward for your effort. And also if it goes against you, you can always sell it at that point, right? Then second, similarly with the selling, the opposite way. If you are, so then use the strategies that are mostly used by traders. The most popular ones, as I was mentioning, is flat lines, moving averages, and the trend lines. Okay, just definitely use them to your benefit. So that's pretty much what I wanted to cover. Now we'll look at some of the examples, but before that, if you have any questions, we can answer that.
Srini, stop loss, I think that is one of the key fundamental key point to minimize risk. So when we say the stop loss, usually Now, what percentage we keep stop loss usually? Let's say, for example, when we buy a stock for, let us say, $2, for example.
See, that is the
And
problem. Thank you. That's a very good question. I think the whole point that I was trying to talk about is you don't put a stop loss 2%. That is for people. If you are a technical trader and you know that you entered this stock because it cleared a particular support, then that is the reason why you entered the trade, right? Then your stop should be should be when it again breaks down through that support. Immediately you should sell it off. That is how I would do that. I would not do a stop loss like 2% or 3% because that doesn't make sense. Because my point is, why when my conditions that for which I'm entering the trade is broken, then I'm no longer in the trade. Does that make sense?
right.
Okay. So we'll look at some of the examples. It will make more sense to you, and this is much more rewarding than just putting a percentage and then or the trailing stop losses and all those things. Okay, that's what it is. Okay, so let's pull out some charts and let's see. Okay, this is pie charts, right? If you look at this pie charts, if you have been playing this, are you able to see my screen, guys, by the way?
Yes.
Yeah, okay, cool. If you look at the pie charts, there's a flat line support at 350.24, and then there is a flat line support at 342.03. Now, if you draw the trend lines, okay, by the way, for those of you who want to know how to draw the trend lines are the lines that are drawn between two highs or two lows. When I say highs or lows, it's a swing high or a swing low, okay? Now, when you say swing high, if you see here, I've drawn it from the date 9/2/20, when the high was at 358.75, and then the recent high by the SPY at 364.38, 11/9/20. Based on this, there is a possibility of this going to, and it retraced from the 75% retracement here. Based on a Fibonacci strategy, this can go to 112.5. If you see here, that's aligning with it, 372. Again, if you look at it, you can draw multiple trend lines, guys. Yeah, I drew a low. This is, if you take a longer frame, it is looking like it is like going uptrend, right? But if I take a shorter trend, right? If I take this high and it formed a lower high, you see this? It formed a lower high on 11/16/20, which happens to be 362.57, right? So when I draw that line, it forms a line telling me that, you see that it never broke above the trend line so far. Are you seeing that, guys?
Yes, just a quick question.
It
Yes.
never broke above the trend line so far. But also I draw a trend line from the swing lows, from the swing low of from 350.51. That was the low that it made about a week back. And then I drew a low yesterday that it made, right? Which is 354.15. And today, where did it went low? Is that trend line correct? Let's see. Today it went to 355.25. That means it didn't break the yesterday's low. So that my trend line is working intact. Now, if you see this, guys, this is called as a wedge formation. Are you seeing a wedge there? Are you guys seeing a wedge here forming, which is called as a descending triangle, or they call it a descending triangle? Are you seeing it?
Yes.
Anybody please answer so that I can know?
Okay.
Yes. Descending triangle. Now what happens is, if the price is in between this wedge, but as it gets closer and closer, remember I told you it is in the accumulation stage. It is kind of like in an accumulation stage. Now it has two choices. As it gets closer and closer, it either has to break out or it has to break down, right? So we are looking at another 2 more days max, right? Because the wedge is getting closer and closer. So if it breaks up, then we are looking at the next trend line support, which is at 370. If it breaks down, we are looking at 350.24. So this is how you look at your charts, guys. You want to see, okay, now what is happening? My chart is like, so if now how do you play a bullish condition? You want to see, okay, this is like a place where you're not yet decided, but you can see for this SPY is not yet decided. So you want to wait until it breaks through. I'll give you another example today, which broke through the wedge. Look at crowd. Look at this crowd, guys. See our crowd strike. You see, I drew a trend line from the higher high to this high, right? It came and intersected here. And look at this. I drew a low high from a swing low here to the next swing low. And look at here, it went here and it broke through the wedge and it is going higher. So these wedges are very, very critical, will help you in understanding where you want to enter. Let's say if you had entered here during the wedge, if you had put, for me in this, what I like about TC2000, it gives me an alert telling me if I can set an alert here, hey, set me an alert when it breaks through this line. So the moment I get the breakthrough, I'll put my order. I have already doubled on this. I would have already doubled on this, right? That's how it is. So you want to make sure this kind of setup. Now tell me one thing. If you are entering this trade, where would you put your stop loss? Rampali, where would you put your stop loss? I would put the stop loss right here below this line, right? Because this means I know this is you want to put here somewhere, which is like what? 139.80. So what I would do somewhere here, this line, wait, what is this price here? Just closer to the thing. It's at 135. So somewhere around 135, I would put my stop loss and I would ride this, right? No, and I would take away my profits as I see, maybe 100% I'll take off. And one more thing, guys, very, very important. I would always recommend you, especially if you're playing options, remove half of your profits at 100% when you get double. The reason is then you're playing with the table's money. The reason is you took away your money and the rest of the things are you're playing with the table's money, right? That means it's like you're going to a casino and you're saying, hey, I got my money back. Now let me play with the profits I made. So you should do that. So these are the opportunities that will give you that, okay? These are the opportunities that will give you, so trading is if you are willing to wait for these patterns, then definitely there's a lot of profits to be made, okay? I just wanted to bring this up. Any charts you want to look at, guys, before any particular charts?
Quick question, sorry, on this one, right? So you have trend lines that you drew, right? And then is there any importance to the Fibonacci time series you drew here? Like, or can we interpret something?
The Fibonacci time zones, let me remove this. I'm not saying it's important, but I'm saying it will give you an idea. For example, right. If you see the CRWD, right? Just before this time zone, you see this? When it went down at this time frame, right? And at this, you need to look at what is happening here. Is it reversing at this time zone, right? Again, this is all a probability game, Bharat. Right. There is nothing like foolproof saying that, hey, this will work like this or not, right? That's what I'm saying. But look at this. It didn't give a big indication here for an uptrend. If you look at this candlestick. So it continued its downtrend, but it went up here. And then usually what I've noticed is 2 time frames. This 21 bar time frame is very, very, very powerful, guys. If you look at Tesla, Tesla also went up during the 21 bar time frame, right? You should look at this. It has been going down, 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 and this 21, it is going down. It has a very big move coming up, maybe a much more bigger move, but you know what? This is a very critical move. You see that it went up, it went even below the cloud here, and then it went up, and then it goes here. So what I'm saying is, the more tools you have in your odds, the better it will be for you, okay?
Thank you.
Does that make sense, Bharat, what I'm talking about?
Yes.
Okay. Again, the other tool that I talked about is the Gann fans, right? If you look at this Gann fan, this looks extremely bullish, right? Because remember, Bharat, you were not there, but if for people who attended Gann fans, all the prices tend to go towards this center 45-degree line. Look at this. This line is way above, and it is above the flat line resistance. So, and it is 2 days above it. So it looks extremely bullish. It is only 1 day about it. So tomorrow there can be a big move in Tesla. So basically, you will see a very big move in Tesla. If you are a risk taker, go for it. You might see I am expecting a big move because it's 1 day above the flatline support of 502, and it is forming a higher high. Okay, it is already at a higher high at 521.85. Okay, did that explain, Bharat, what I'm talking about?
Yeah, I did.
Yeah. Okay, cool. So, I mean, you can draw to any levels, right? I drew from this level, but let's take some other example. We played Love, for example, recently. This is one of the strategies that we played. We played around, we entered this at 41.40 somewhere here, okay? Some people already doubled and they took away their money. But if you are, but what we are looking at is, look at this. It has been going, this is a bullish candle here, right? So this is a bullish candle here. And then the next day, tomorrow, it is entering this, this time zone, which is number 3. So I expect a bullish move to somewhere here. So, I mean, the time zone doesn't tell you where the move is, how much is the move, but it will tell you that there's a possibility of a big move. Usually, the reversals after this, it might reverse again. We never know, right? That's what it is.
Okay.
Make sense?
Yeah, makes sense.
Okay. So I just wanted to show you. So flat lines are also very, very critical, guys. Use the flat lines. Flat lines is one of the oldest strategy used by traders. So it will help you. The more you play technically, the more you can rake up your profits. The reason, when I meant technically, what I mean by that is, for example, they were asking, how do you specify your stop loss, right? If you can specify a stop loss technically, saying that it is below this line, then I would get out of the trade irrespective of it, then it will work like a charm for you, because your move will be bigger and you will also be able to do this. But sometimes the setups, you may, before you enter, it may move high. So you must be willing to wait for those moves, or there is always a better trade coming up for you, right? You can let go of some of the trades. Any charts that you want to look at, guys? I'm sorry, we have 10 more minutes, 5 more minutes. Any charts? Oh, I wanted to look at our Ben. What happened for the earnings?
Can we check Peloton, Srini?
Huh?
Peloton?
Peloton, okay. So Peloton is not even in my frame. First of all, I would not enter this trade because it's in the cloud. Remember, the cloud is like kind of like an accumulation in Ichimoku, right? If it is below the cloud, for those of you, I'm just giving a very quick thing. If it is below the cloud, it is like bearish. If it is in the cloud, it is like sideways. That means it's in an accumulation mode. People go left and right, they go up and down the cloud, and you never know when they'll break out, right? So this is one thing. And then then the accumulation, and then this accumulation will happen. So that's why it was very, very important to have a scan list, how you play, how you look at the stocks, right? You want to have a criteria. For example, I have here a 2-day uptrend conversion line. That means it is 2 days above the conversion line of the Ichimoku, and then it will tell me what are the various charts. One of the charts that we were looking at is today's Urban. Urban is like 3166, but we already made profits on it. Curvo is another trade that could be a good one. So I'm just telling you, this is a scan that you want to have in your arsenal. It helps you a lot. But look at Peloton. I drew the trend line from the previous. Look at it. First of all, it formed a lower high, right? Which is not a good sign. Whenever you see a lower high, that means it is getting down. That means it's getting down. And you see here, it started forming lower lows. Now it is trying to go up. So you want to see this above this line, because if this line, if you see this, it is coinciding closely with the cloud. Are you seeing that? So all these indicators will line up, guys. So this is coinciding with the cloud. So this is how we do things. For example, I'll show you another example. What we played is called Mayo. So Mayo, what happened, this is a biotech company, guys. I don't know what they do, but this came up in the radar. And we played it once it broke through this flat line above the cloud. Look at this. This move has been good. It is already about 40% right now for us. What we are looking for is it breaks through this. And one more thing, guys, when you see this kind of a move and you see the trend line above, you can be confident a little bit saying that it can break through this flat line, right? For example, this one is like really going up. So if it breaks through this flat line and it goes to 24, that's what we are hoping for. So, and if you see the thing, the trend line on the bottom, it's way below. So my support at this point will be the Ichimoku cloud lead span B. So that's what it will look like. I'm just giving you these examples to make you understand how things work, how you can use all the indicators and all those things. And look at this Mayo, it is very close to this 8. So, and it is bullish. So we might see another big move tomorrow. And we want to get out before this bar because we never know unless the trend is still upwards. Okay, that's what it is. Okay, so what else you want to see? Oh, today we played one stock, guys. I wanted to talk about TTD. Look at this TTD, guys. It's looking extremely bullish. You see this? It is going to 1,000. Basically, you look at this trend line. It is today at 8. We entered it at around 820 today, and today and we bought 900 options. And today it is, and we are expecting in another 5 days, like 4 to 5 days, to hit 1,000. And I checked with the Gann fans here. The Gann fans is also aligning the next week. There should be something going on in this chart. Okay, that's how we can do the TTD. Is also a very good chart that you can consider. So the trend lines help you, will show you. The flat line supports will help you. The flat line, sometimes the trend line and the flat line could be the same because you might see two swing lows at the same level, right? That means the flat lines are and the trend lines are the same. Make sense what I'm talking about? But I mentioned this risk trade as high because there's a very good possibility. If you look at it here, the conversion is at 777.93. So it's way above the conversion. So, but if I look at, there's a very good possibility it can go up, or it has enough, or it can go down all the way and then come back up. But looking at the markets going up, I feel that this will go up. But if the market tends to go down, it can go back to the support and then come back here. So that's why I said the risk level is high. Don't play too much. There might be a possibility of averaging it up in our option analysis today in our services. Okay.
So if it goes down, it goes down to the
conversion
740, 744.
Conversion, which is at 777.
Okay.
And the moving average 10 is also around that range. 771. So 770 area you're talking about. Okay.
In this case, where would you put the trading stop?
I'm sorry, sir. Come again.
Where would you put your trading stop in this case?
Facebook.
Stop loss.
The stop losses.
Stop losses.
For Facebook?
No.
Oh, for this one.
For this one, right? So based on the flat line.
Stop loss will be again. I don't recommend a hard stop loss, but I would recommend you to sell it off if it is going below 770. Usually, what I say is if it is staying below the moving averages, let's say MA10, which is 771. MA10 is used by most of the traders. If it stays below 771 for 2 days, that what I meant by that is closing below 771, not like touching and going, right? That means if you see it is closing below 771, that means it indicates that there is a selling pressure. So that is what I would consider as a stop loss.
Okay. Okay. So that means it's descending basically. That's when you not a percentage or a hard dollar.
No, because percentages are like, see, in this case of TTD, right, it doesn't make sense, right? It's a very volatile stock. Look at this ATR. If you look at the weekly ATR, it is around $86.90. So it can move $86 down, $86 up, right? So you don't want to lose a trade because it just moved up and come down, right? You need to be aware of how much is the volatility of the stock, how much is it. If you don't, what I would recommend is if you don't want to handle that kind of pressure, then please do not enter the trade, because these stocks tend to do that, right? If you, for example, if you say the way TTD worked, you see here on 2 days, it went from a high of 847.50 and then it went to a low of 697. That means you're talking about $150 move in 2 days. And then again, it is back from 697 to 840, again $150 move, right? But it took longer this time. Make sense? But another thing which you can check is the Haikanashi, which we talked about. I can talk about this one more time. Where is the Haikanashi? Haikanashi, if you see this, this looks like extremely bullish. You see that it's like all green arrows with no lower wicks. So this is definitely looking very, very bullish, right? For those people who have attended Haikanashi, they understand what I'm talking about. The Haikanashi strategy also tells you that this looks very extremely bullish, right? So this also tells you to stay in the trend rather than getting carried away by the daily movements, right? That's what it is. Okay, I think we are at the top of the hour. I just wanted to share some news with you guys. I wanted to share something about our services, basically a little bit. I won't take a lot of your time. To talk, this is our return tracker for our services. We maintain it as much as to live as possible. This has not been, we take care of, we show what we do with the trades that we do. And I wanted to tell you, so far we have been tracking this from 7/28, okay? That is when we started. We had a total trades of 116 trades. In that, our winning trades have been 71. And the losing trades, when I meant by losing trades, we lose some of them 30%, some of them 100%. And by the way, most of them are option tradings, okay? Option trades, and not all of them are option trades. So we had 50% trades, it's 54%. And our winning percentage was like 71%, but last week we got hit a little bit, but we are still at 61%. But our returns in the, like, though I have mentioned here winning trades and I mentioned 50 because that is the minimum, our winning trades have been massive last week. For example, we played trades like SMA and all those things. You see here, let me show you, where is that? Snap is like this, 93, 129%, 344. You see this, the 344 and those kind of winnings, right? So our returns so far, if you have used the 5% position size, has been 132%. This is in 4 months, guys. I mean, definitely totally blessed to be here. And we trade real in this portfolio. And the position size, if you are 2%, that means if you're playing with a 100,000 portfolio, we talk about 2,000 for each trade, then we are looking at 52%. If you are using a position size of 5%, that is $5,000, then we are doing. And on a max, we have 10 to 12 trades open. That means we are only utilizing 50,000. That means 50% of the portfolio. The rest 50% is lying on cash. Okay. So I just wanted to bring that up so that you're not like losing your trades or anything like that. So this is our winning portfolio. This is what we generated out of our services here. And this is the blog that we have. And this is the services that we have. And it's pretty much clear, guys, what we provide. We have a free plan where we give the daily market analysis, like how we give every day. the daily option trading ideas and the market analysis. And this monthly plan, we give, this is what we give, where we give 6 to 10 option picks, where we say, hey, we walk you through the trade. We tell you what is the entry point, what is the exit point, how do you execute the trade, how do you get out of the trade, etc., and the technical analysis behind it. Just for your information, guys, if it's something that interests you, we have a free trial too, 5-day free trial. You can check it out and check it out for yourself if it is for you. I understand if it's not for everyone, but if it is, but only you can decide if it is for you, right? So check it out and let us know if we can be of any help to you. Okay, that's all I had for today, guys. Anything that you want to cover before we wrap it up?
I think again, Srini, for not experts, basically, so the people who just started and learning and trying to just learn things like me, if you could, guide us that, the exit criteria, that helps a lot.
Mm-hmm. Yeah, definitely. Exit criteria is very, very critical, guys. That's what I would say, because especially in the volatile markets like this, you don't want to just specify some stop loss and get carried away by that. You want to back it up with technical buying pressures, where the selling pressures are, and all those things. You should know where it is, and then you should be able to do that. Yes, that's a very good point, actually. Yeah, that is where we provide our expertise. We try to educate you with those information, and the more you look at the charts, the better you will become at it. Okay.
Also, Srini, position and sizing is also one of the important things, which I'm definitely.
Position sizing, I already mentioned. If you look into this one, profit loss, I would highly recommend, if you are a beginner trader, don't use more than 2% of your trade, 2%, max 5%, because it's an option trade. In the case of, let's think about it like this, guys. If you are trading something with 100,000, and if you are putting 10,000 in each of the trades, how many trades can you play if all the 10 trades go down? You can only pay 10 trades and you're broke. And I wanted to bring this up, very, very important, because this is very, very critical, guys. I want to share something, since you asked for it. How difficult it is to get back your portfolio. Okay, just bear with me for a minute. I want to share with you guys something. Is that okay? See this, guys, my screen?
Yes.
If you see this, this is the calculation, guys. If you lose 10% of your trading capital, it takes 11.11% to recover the loss. If you lose 20%, it becomes 25. If you become 30, it's 42.85. As it gets more and more, if you lose 80% of your portfolio, you have to make 400% back, guys. So it's very, very important that you do the position sizing to not more than 2%. If you are a very beginner, I would highly recommend you to start with 2%. And and understand, before you trade, understand the technical trading strategies, or use somebody who knows what he's doing, so that you can make sure that your portfolio is not blown away, right? If you have a big drawdown like 80%, think about it, guys. How to make 400% with the 20% of the money? How feasible is it? It will take years to go there. Like even in the trading world, for example, I'll show you one of the trades. Even in the trading world, right, it takes a lot of time to get back to the highs. So Tesla, for example, it took a long time. You see that? Tesla, if you see the daily chart, it went to the high here, and then it went to the low here. To get to this high, it only fell 4 days. But to get to that height, look at how many days it took. That's the same thing with your portfolio, guys. To lose is very, very easy. To gain it takes a lot of time and a lot of effort. So play smart, use your position sizing. Don't ever exceed the position sizing at any cost. Don't break the rules, okay? That's what it's all about. Does that explain your question? Hello?
Yes, yes.
Okay. Okay, so shall we call it a wrap, guys? Anybody else, any other questions?
Thank you, Sri. This was helpful.
Okay, guys. Hey, have a wonderful evening, guys. Okay? Talk to you later.
Thank you.
Yeah, bye.